Hello everyone, my name is Shruti Koitnala. I study in class 11th. I study in Cambridge School in Indirapuram, and these days I'm doing an internship under the guidance of Dr. Shanil Tripathi. This internship is all about financial literacy and equity cult. Yesterday we had the session number 4 of this internship, which was all about indicators, and today I'm going to share all my learnings from this session. Indicators are the tools which help us to identify when to buy and when to sell the shares. These indicators are developed by real-time investors and researchers. The indicator which we learned yesterday is DMA. DMA stands for Daily Moving Average. Now, if we take the price of a share of 5 days, add them up, divide by 5, then we will get 5 DMA. Similarly, if we take the price of 10 days of a share, add them up, divide by 10, then we will get 10 DMA. Now here we can take any price, be it closing price, opening price, high price or low price, but we generally go forward with closing price. Now there are 4 important DMAs. The very first one is the 5 DMA, which gives us the average price of 1 week. It is generally used for very short time period. Then we have 20 DMA, which gives us the average price of 1 month. It is used for short time period again. Then we have 50 DMA, which gives us the average price of a quarter, which consists of 3 months. It is used for a time period of mid. And then we have 200 DMA, which gives us the average price of 1 year. It is used for a long time period. Now all of these DMAs are time specific. The next thing which we learned are that there are 2 types of traders. The first one are the value traders. Value traders are those traders who analyze and research about a company. If the valuation of a company is of 100 rupees and if they are getting it for 50, then they will invest into the company and vice versa. Second type of traders are the trend or growth investors. These type of investors have the expertise and knowledge, and they use that to find out the upcoming trend in the market. They go forward with the upward trend and buy the shares, and when they see or predict that this trend is going to fall in the future, they sell the shares. Now, how do trend investors use DMA as an indicator? When the candles of a stock are below the DMA and it's going to cross and it moves above the DMA line, then the trend investors invest into the business. Now, DMA is not a sure shot tool that you will always gain profit. Maximum time you will gain profit, but at times you will also have to face losses in this. Now, how do value investors use DMA as an indicator? When they see that candles of a stick are much below the DMA line, then they invest into the company as they know that they are getting this at a bargain price, which means they are getting it at a price which is much lower than its value, and in the upcoming days the rise will go up. The next thing which we learn is about crossover when we use 2 or more DMAs together. Now this is generally used by trend investors. For long-term time period, we use 200 DMA and 50 DMA together. For short-term period, we use 5 DMA and 20 DMA together. And for medium-term time period, we use 50 DMA and 20 DMA together. Now, when a short-term DMA line cuts the long-term DMA line from below, then the investor will buy the shares. And when the short-term DMA line cuts the long-term DMA line from the above, then the investor will sell the share. These are all my learnings from this session. Thank you very much, sir.